Welcome back. Time for Ask Annex. Head to the website, annexwealth.com, and look for the Ask tab. Fred Coleman's in the studio. He's CFP and a branch director. Welcome.
Thanks, Danny.
Matt Morzy, director of research and a CFP. Welcome to you.
Thank you.
Question 1 on Ask Annex. My kids, 35 and 28, insist on investing in cryptocurrency. I'm fine with that, but is there a rule of thumb as to what percentage of this, I love this part, quote, play money investing makes sense? I say less than 10%. They feel more is fine with their time horizon.
First of all, it's a really good question and probably a really interesting conversation that they're having about that. I would have guessed before seeing the 10% that the play money would have been less than that, but that's probably a really personal, number. But the way I kind of think about that is assume you lost everything. That's kind of how I view play money. If you lost everything, how would that impact your financial plan? Or maybe emotionally or psychologically, would that impact you if that went down to zero? Depending on how they're playing cryptocurrency, there's a lot of them that are much more riskier than others and could certainly go down to zero. And so if that happened, is that going to really impact your plan and put you in a worse off position or stop you from doing something going forward? I almost view it in a much smaller degree of like going to a casino. If you're going to go and sit down at a blackjack table, the amount that you play should be something you're comfortable losing and saying this is part of the game or part of the entertainment. That's kind of that viewpoint. Now from investing, that's going to be a larger dollar amount than you're probably going to a casino with. But that's kind of the same thought process that I would have. But, a percentage is, one of the things about percentages is that it's relative to each person. Is that 10% for a 35 and a 28-year-old is very different than 10% for somebody who's 55, 60, or 65. They're not as well established, so 10% from a dollar amount standpoint is going to be a lot less. They might feel comfortable going higher than that because the dollar amount is minuscule to them compared to maybe what their parent is, where they have worked for quite a long time, have accrued a big nest egg, and work from there. So, percentages are one thing. It's nice to be able to use that to equalize things, but at the same point, the dollar amounts can be much smaller and maybe easier for them to handle.
Yeah, completely agree. And one of the big things before even thinking about crypto or any type of investments are thinking about making sure that you have that foundation set. So having that emergency fund, do they have the 3 to 6 months worth of emergency expenses? Are they taking advantage of their 401k match? Have they paid off any type of high interest debt? Consistent 401k contributions. Once you covered all those things, then we can talk about that speculative bucket. And yeah, when we think about someone that's in their 20s or 30s, they do have time on their side, but that doesn't eliminate the risk. It just gives you a little bit more cushion to recover from it. So making sure before you invest in anything, knowing what you own, making sure that they have a understanding of cryptocurrency. And I would say gradually scale into it. Don't just jump into it right away, and also have your exit strategy if you need to. And all that should be based off of your financial plan.
Fred Coleman, here's a good one for you. How many of your clients report regretting putting money into their homes in the 5 years before retiring and selling? We do. Put over $40,000 into a project that the new owners wound up completely redoing. It might have helped sell the house, but did we throw that money away? Now, when you are dealing with clients, are these things that as a wealth manager they should share with you?
Yes, absolutely. And I hear this all the time. This is something that we want to hear. These are the things that matter. Not only saving and investing and growing assets, but what are we going to do ultimately with the assets? And a lot of retirees, this is actually one of their biggest regrets. Once they get close to retirement or retirement approaches, they're like, hey, let's fix up this house while we have the money. And if you're planning on selling it, most buyers, they have their own taste. So they're going to come in and remodel and do whatever they want to do. So when you think about home improvements, you're pretty much never going to recoup 100% of the money that you put back into it when you sell. So you want to think about what you're actually spending the money on. What I've seen is if you're replacing something that, requires the house to operate, let's say like a garage door, a really basic, kitchen remodel, you can get most of your money back. But if you're looking at like luxury upgrades, you'll be lucky to get half of that money back. So a lot of these things can help the home sell, but it's really things that you want to think about because it does affect your financial plan if you're not going to recoup that money back.
Yeah, I think the one line in here that stuck out to me is that they're concerned that after they sold it, the person redid it. And at that point, it's not your home anymore, which is really hard to, I think, separate yourself, especially if you were there for a long time because of the stuff that you did to it, the memories that you have, like you said, the money that you put into it. But once you've moved, just like you did things to your house, somebody else is going to do something afterwards. And you can't be hung up on whether or not they're going to like it or not like it after the fact. It's really, are you going to get the use out of it yourself? Is this going to be enjoyment for you while you're still there? If so, great. And if it works in your financial plan, those are kind of the things to look through. But in terms of what they do after you move out, that's, essentially out of your hands.
A couple of weeks ago, we went and looked at new front doors. And I've been out of the market for a while looking at front doors. And when she gave us the price, it was like, okay, well, normally for that, somebody's opening for you every single time. I mean, it was a lot. You put a bidet in. Was that a good investment?
I didn't hear about that one.
Not going to do that. Okay. All right. Matt Morzy, Director of Research and a CFP at Annex Wealth Management on Ask Annex. Thanks.
Thank you.
Fred Coleman, CFP and a Branch Director. Thank you.
Thanks, Danny.